Imagine making money in your sleep without ever having to wake up and look at a damn chart again. Sounds like you're still dreaming, right? Wrong. It is most definitely possible, and I do it every single day. Today, I'm breaking down 4 of the most powerful ways to earn passive income in the crypto industry. From staking and yield farming to lending and providing liquidity, I'm gonna give you all the steps today. What's up, guys? I'm Parker Ray. Today, we're going beyond trading. Trading and all these different charts you draw on TradingView, that's just astrology for men. Is any of that even real? I don't know. But you know what is real? Making money every single day with crypto, and I don't have to look at a chart. I'm gonna explore how you can go beyond trading and build passive income streams through cryptocurrency. Trading isn't for everyone, and the best part about these strategies are that you're not glued to a price chart all freaking day, basically working another job. These strategies just work for you. In this video, I'm gonna walk you through my top 4 methods, and I'll cover how they work, the potential returns, and the risks inherently involved. You ready to learn how to make your crypto work for you? Let's do it, baby. Method 1. It's one of the simplest ways to make extra money in your crypto. Staking. Super simple for a big crypto guy. But really, it is one of the easiest ways to earn an extra income off your crypto. If you're holding a proof of stake crypto like Ethereum, Cardano, Solana, Sui, for example, you can stake your tokens to help validate transactions on the network, and in return, you receive rewards. Similar to earning an interest on your savings. Now, the biggest cons to staking is that your funds are often locked up with like a 3 to 7 day unstaking time. If you venture over to the Cosmos ecosystem, you're looking at 21 days sometimes. So you might not be able to access those funds right away if you need the cash. You have to wait for them to unstake. But these methods are great for long-term passive rewards. However, me being the DeFi pro that I am, I introduce you to liquid staking. Now, liquid staking is the exact same process as staking, except you're holding a token that's representative of that stake position. Now, just to simplify things, you're gonna get the staking APR just like you would traditionally staking, except you're not gonna have a lockup time, because you can get on your DEX, like let's say we're on Solana, right? I can stake my Solana for 7 days, or I can stake my Solana for 7%, and I'll have like a 3-day unstaking time. Or I can buy a liquid staked Solana through either Jito or Jupiter, so Jito stakes Solana, and earn 8-9%, and I can swap out of it anytime, 100% liquid. Saves me so much time and money, can sell at the perfect time, no 3-day window. Anyways, I digress. Use liquid staking at all times. And honestly, if you're not, you're just leaving money on the table. I have a bunch of Solana that if I didn't have in Jupiter staked Solana, I'd be missing out on 10% extra a year. If you have 100 grand, let's say you have 100 grand in Solana, that's an extra 10 grand of Solana a year. I want that 10 grand. I ain't saying no to that. So you only got 10 grand in Solana, right? If you're making an extra 10% a year, that's an extra $1,000 in Solana for doing absolutely nothing but making sure that you have a staked position. So if you have these coins, make sure to stake them if the opportunity presents themselves, and use liquid staking when possible. It'll just save you time and stress. So now we have crypto lending. I prefer to stick with decentralized applications like Aave or Moonwell or Extra Finance. These are places I like to go and lend some stablecoins, for example. And I can get an easy 10 to 12% off my stablecoins, which is gonna outperform any savings account out there in the world. There's no way it won't. It outperforms the stock market, and it's just the dollar. I call it the holy grail of traditional investing because I'm getting 10% a year on stablecoins that have no up and down price action. It's absolutely insane. I'm beating the S&P with the dollar. Get fucked, TradFi. Anyways, but it's nice because you can get yield on more than just your USDC. So if you have Bitcoin, Ethereum, Solana, all these different assets you own, most of these can be lent out. And there's all different kinds of opportunities where you can be earning 3, 5, 10, 20% on your cryptocurrency. And the best part is that these are assets you already own. So you're just earning that extra income per year off assets you'd already be holding. Not doing this is just leaving money on the table. And the other side of this is that now you can also borrow against the cryptocurrency that you've supplied. Let's say I want to try this out. I get on Moonwell, I want to lend $10,000 of the new Coinbase wrapped Bitcoin that came out, right? So I think it's about like a 3% interest rate on that. So I got $10,000 earning 3% on it. That's cool. It's cool. Whatever. You know, nothing crazy, right? But now I can pull a loan against that Bitcoin. Say I got some stuff in real life I want to pay for, but I don't want to sell my Bitcoin. I can deposit that Bitcoin where I'm still earning that 3%. Say I have a big tax bill due this year, right? But I don't want to sell my Bitcoin because I'm keeping my Bitcoin forever. I'm not selling Bitcoin to pay taxes. Fuck that. I can pull out a loan against that Bitcoin for 5 grand, go pay my taxes, and, you know, Go take a vacation, whatever you want to do with that. Go buy a car with X amount on that loan, and it's 1%. Lending is awesome because it offers steady returns on assets you already own. These are assets you already own that you're just making extra money off of. There's no reason not to be doing these things. You can be earning extra income and interest off everything from Bitcoin to stable coins. Again, a super savings account, the holy grail of traditional investing. You'll beat the S&P on stable coins. It's insane. The RR on that is insane. Now, let's go into the cons and risks. The main risk here is counterparty risk, which is like the exchange or the platform goes down. For example, Celsius. Everyone remembers Celsius. Even if you weren't in crypto back then, you probably heard about Celsius FTX collapse. Yeah, not good. But that is the biggest risk to lending. So you want to make sure you're with long-standing platforms that have been around for a while. Lending is ideal for people that want to just generate a little more income off like their large cap assets they already own or stable coins, or they're just looking for a consistent income to come in off assets they're already comfortable holding. And lastly, I'm lumping these two together because they're so similar, and that's yield farming and liquidity providing. This is what most of my portfolio is in right now, is just liquidity providing and yield farming as well. Let me explain a little bit about what these are. Liquidity providing and yield farming essentially comes down to you're providing assets to a decentralized exchange via a smart contract. Then when people are coming to the decentralized exchange to buy assets, they're swapping through your assets. And so for example, when you're providing liquidity, when people are paying that small swap fee, say it's like 50-cent fee, that goes to the people providing liquidity. So now imagine that millions of people are doing that per day. Millions of dollars of volume is coming through. Those hundreds of thousands of dollars in fees get paid out to the people providing liquidity. And the biggest difference between liquidity providing and yield farming is that liquidity providing, you're paid directly from the fees, whereas yield farming, you're getting paid incentives from usually a reward token on a certain platform. For example, on Aerodrome, on Base Chain. When you provide liquidity over there, you get paid in the Aero token because it's yield farming. You're depositing and they're giving you a yield on the tokens you're providing. Whereas let's say on Orca, let's say over on Solana, Orca Dex, for example, let's say you got Solana and USDC paired together. You're gonna get paired directly on the amount of volume coming through, and you're gonna get paid all the fees people are paying. Anyways, it's a beautiful thing. DeFi is amazing. It's literally an exchange by the people for the people. It's crazy. You can break free from banks and institutions so easily. They're all fucked. They're all scamming you. Get into DeFi. It's a miracle out here. This world is crazy. It's so amazing. I don't think it'll last forever. It's too good. Liquidity providing really shines during high demand and high volume times because all those transaction fees people are paying are coming through in record high numbers getting paid out. So high volume days are super, super impressive. And the biggest con to liquidity providing and yield farming is just impermanent loss. You're pairing two assets together. So if one out appreciates the other one, you might be wishing you were holding more of a spot allocation of that bag. Liquidity providing can be super rewarding and it's super profitable and it's one of my favorite strategies in the crypto space. But you need to have a solid understanding of what you're doing and what the underlying assets you're holding in those pools are. Otherwise, things might not go the way you think they're gonna go. Make sure you're not always chasing the highest yield possible and invest in long-term coins that you want to be holding for this bull run. If you're finding these methods useful, hit that like and subscribe button for more crypto tips. And let me know in the comments, which passive income method are you most interested in? Let's keep the conversation going down there. To wrap it up, not that I ever wrap it up, but to wrap it up, there are plenty of ways to earn passive income through crypto without ever even having to touch a trading chart. Staking is ideal if you want just a little bit of money that's relatively safe and just simple to use. Yield farming and liquidity providing can offer a lot higher return, but come with higher risk as well, and you need a deeper understanding of what you're doing. And lending is a great way to earn steady returns, especially with things like stablecoins. For example, lending is currently my post-bull run plan. Take my profits in USDC, lend out for 10%. Say you're sitting on, let's use a theoretical $1 million. If you're making 10% a year off $1 million in stablecoins, you're making $100,000 a year for doing jack shit. Boom, baby. I'd say that's pretty damn good. The key is to pick the strategy that matches your risk tolerance the best. Research each option and remember that passive income isn't always risk-free. But by using these strategies, you can make your crypto work for you and be making money while you sleep every day to add to that crypto bull run bag. Thanks for watching, guys. If you're ready to put these passive income strategies to work, please hit that subscribe button for me to show your support and hit that bell to make sure you don't miss out on any future videos. And don't forget, share your favorite passive income method in the comments below. And if you have any questions about any of these strategies, really just leave a comment I'll touch base with you down there, and I'm happy to help you out any way possible. Just watch out for bots down there. There's so much scam shit going around. It's actually insane. See you soon, guys. Bye.
Girls get loose when they hear the song. 100 on the dash, get me close to God. We don't pray for love, we just pray for God.